because I'll need to do something with the sound, I think.
Yes, I made you the co-host, so
Okay, perfect.
you should be able to.
Okay, so let me make sure. I will do a screen share. Okay, can y'all see that? Saving like a 1%er?
No, it's still on.
No.
It's still
Okay,
on your screen.
here we go.
Let me see
hold
here.
on.
There we go.
Well, that's not that part. One, two. How's that?
Let's see
Does it
here.
say saving like a 1%er now?
Yes, it's showing
Oh,
all
I
of the
can see it.
pages.
Okay, perfect.
Yeah.
And there's one thing more about sound. Hold on, sound share. Okay, so thanks for taking time out. I know everyone's busy. I appreciate it. The idea for this workshop was to help people understand there's a savings crisis in America, not to get on a soapbox about it, but there's a lot of people that aren't saving enough. So we're trying to figure out how to get the word out about some better ways to save. So the idea is, you hear a lot about the 1%ers. Most of the time it's something negative about, they're this, they're that. But what we tell people is a lot of 1%ers are saving the right way because they either have the ability to do it, or they've been, financially aware the right way, or they learned the right things or something. So our job is really to try to get the word out about how to save better and closer or more like a 1%er. So the interesting thing is, a lot of what we're talking about today, you probably never heard before. So let me go ahead and get started. So we kind of talked about it earlier, just go Buccaneers. I mean, wow. What a perfect example about doing things the right way to have effects that are long lasting and, permanent. So what Tom said is that, we're champions now. You can never take that away from this team, which is awesome. Those guys they'll be old men one day talking to their grandsons about how awesome it was to dominate the Chiefs in the Super Bowl. So I'm a fiduciary financial advisor. I started Thoughtful Advisors in 2015. I've been a square peg in a round hole my entire life. I worked at First Union Bank. I worked at Merrill Lynch. I worked at American Express Financial Advisors. I was a wholesaler at Franklin Templeton Investments. So I've always had this drive to do the right thing. And in this profession, there's not a lot of people that tell people the unvarnished truth. Now there's a polite way to do it, but a lot of times information is not provided, more or less withheld, as a way to either make something easier or not scare a client or whatever. So any of you guys that know me through the chamber, I try to be very polite, but I speak my mind from an idea of there's always a nice way to discuss things, and ideas are not bad. It's just, how you take them and what you do with them. And the idea is that we want to explain to people what's the best way to do something. So we have a philosophy where it just says, understand what's possible. And it's based on 2 observations from clients that, people I've worked with or admired. I actually saw Sir John Templeton in Nassau, Bahamas, present to our group at an annual conference. And he had just a wonderful quote where he said, if you want to have better performance in the crowd, you must do things differently in the crowd. So if you do what everyone else is going to do, you're going to get what everyone else is going to get, which is not necessarily good. Once again, going back to the Buccaneers, that, Brady does things differently, which makes him better. He's not the most athletic guy, but he's certainly the hardest worker, and he's certainly the most progressive from a thinking perspective. So you got to think about how to do things, and can you do something better than someone else is doing it, and that'll allow you to get ahead of what they're trying to do. The next one is a great one from Steve Jobs. People don't know what they want till they know what they can have. If you think back, now I'm going to date myself. In the early 90s, when mobile phones came out, it was some kind of magical, crazy thing where you could literally make a phone call from your car or outside of your building without being tethered to a long line at your house or your office. So those were like magical little things. And all of a sudden, Steve Jobs said, well, you know what? How about you have a magic little thing that's a supercomputer that you put in your back pocket and you can make calls on it. And all of a sudden everyone said, oh, what, you know what? I don't want a flip phone. I want that thing. So he has this idea that if something's out there and no one knows about it, they don't know whether they want it or not. But once you explain what's out there, people say, oh, that's relevant to me. I want that thing. I didn't know about it. Now that I do, I'm going to do something about it. So what we do is we help people understand what's out there. We show how what's available. We explain how it's different, and then people make their own decisions. I'm not a sales guy. I tell people I'm in the information business. I'm not a convincing business. If something's out there and someone wants to do something about it, we'll help you with the information. If someone doesn't want to do anything about it, call me when you need me. Otherwise, have a good afternoon. So, graduated from University of Florida. I'm a 2-term treasurer at the South Tampa Chamber. My last term just rolled off in January. We're in capable hands. Kevin is coming on board, so he's going to do a great job. I'm also a member of Tampa Bay Estate Planning Council. That's where some of this work from this presentation came from my background there. And I'm a member of the University of Florida Advisory Network. That's a little more of a philanthropic thing where we help people understand how to make donations to the university in a tax smart way, which also kind of rolls into what we're doing here. So I have 2 little boys. I coach Tampa Bay Little League and just finished the Under Armour flag football season. And I've been a 31-year resident in South Tampa, once again, dating myself. But as I joke with my wife, living here was not an accident. It was a decision that I'm thrilled we made a long time ago. So when we design retirement plans for businesses, and what we typically will ask to sit down with the owner or the CFO or the CPA on behalf of the owners, we'll ask them, we're like, well, what do you want in your plan? What are you trying to accomplish? And we'll always get a few things that come up that people are like, okay, well, we want tax deferred growth. We want tax-free income. So usually that's either a 401k or an IRA or a Roth IRA or Roth 401k. They'll say we want market-driven returns, index funds, low-cost mutual funds, things like that. Safety of principal, a lot of times that's kind of like we need a stable value fund or something in the plan, like a CD. Want liquidity, you don't want money to be locked up. You want cash in the event of injury or illness. And that's something's a little interesting because there's a few ways to do that. And also they want some kind of matching funds. And a lot of times it's not really that the business wants the matching funds from an expense, but they want the matching funds to encourage their employees to save. And the match is more or less an inducement to get people to do something from a incentive perspective. So, that's a 401k match. And the idea is that savings is a process. But what the 1%ers do differently is they shorten the time frame. So one of the ideas we're going to talk about today allows you to do all those kind of things with 5 payments. So instead of doing it over 10, 15, 20 years in a 401k or things like that, we'll show you how to shorten up that time frame. Now, I know something might be popping in your heads because it pops into a lot of people's heads. They say, okay, well, I like the idea of the design, but I'm not sure I believe you can do something in 5 payments. And I say, I know why you're thinking that because that's what my wife said. So now the big question is, how do you change, or why should you change where you're currently doing? Because everyone's already doing something. And I once again, I talk to people, I'm like, doing nothing is doing something. But most often people are doing something, and unless there's a reason to change, you're not going to change. So we're going to kind of go through and explain why you might want to change and how that would be different than what you're doing. So the idea is that there are 3 primary risks that can destroy any retirement plan. And the first one is market risk. And those that lived through the .com bubble burst, remember, the news and, the tech crash from NASDAQ's high of 77% loss over about a year. The credit crisis in 2008 was a disaster. And we're in what's called the everything bubble right now. And let me make sure. Now, can you guys see that screen where it says everything bubble on it? Hold on, let me think. Do this. Now, can you see that?
Yes.
Oh, okay. So this is something where, in this case, now this is from 2017, but it's talking about how, you know, there's a cryptocurrency bubble. Now, I'm not sure how many people do that. We don't do that stuff. But there's a real estate bubble. We know that. We live in South. If you live in South Tampa, you live in Tampa in general, the real estate's crazy. Lots down here that are getting torn down. The developers are paying $250, $275, $300, $350 for these lots. They're building these gigantic McMansions, and they're selling them for $700,000, $800,000, $900,000. And in our neighborhood, when we walk around with the kids or ride their bikes, we're like, who affords this stuff? I mean, but it's low interest rates. And we're in a real estate bubble, and it's also commercial real estate, stock market. You know, there's just stocks. It's, you know, everyone's talking about the FANGs, Facebook, Apple, Amazon, Google, you know, Tesla's another one where the fundamentals are just crazy. Auto bubble. I had a buddy of mine that owned 3 car dealerships, and he sold them about 4 years ago. And he said the auto dealership business is insane. And he goes, I cashed out. I didn't want to deal with it anymore. People are buying cars that shouldn't be in cars. The lease terms are crazy. So there's an auto bubble, corporate credit bubble, stock index bubble. So there's just risk out there. So the idea is that you want to be aware that there are things that could harm your investments. Market risk is one of them. The next one is tax risk. And I tell people, we do taxes, and tax risk is just insane right now. So let me show you. Now, this is the US debt clock. Can you see this? Does it pop up now on the screen? The debt clock? Okay. Well, debt right now is 27,894,494 million, and 500,000, 600,000. I mean, it's going up every literally few seconds. So the debt per taxpayer, and debt per citizen is 84,000, but that's citizen doesn't count. People that pay taxes, debt per taxpayer right now is $222,192 per taxpayer. Now, understand from tax perspective, 50% of the people that file taxes get money back. They get net income from a tax filing, not net tax payments. So taxpayers each owe $222,000. So my wife's a taxpayer, I'm a taxpayer. So the LoDuca family owes $442,000 in current taxes. Now, that's already a lot. Let me show you in 4 years. Here's the estimate. It's going to be $365,309 per taxpayer. So you get $700,000 in the LoDuca family in 4 years of tax obligations. So taxes, once again, could be a incredible drag on earnings. And what we're worrying about is we tell our clients that if you're saving all this money in 401k plans or IRAs or any kind of pre-tax savings instrument, the IRS is going to have you take it out in the future. And if you're giving away 50, 60% of your income in the future, you know, that's going to crush your expenses because you're not going to have enough income. So the idea is that you want to figure out how to be as tax efficient as possible so that if tax rates go up in the future, you don't have to give, you know, a quarter, a third, 50, 60% of it to the IRS. The last thing that most people don't talk about is what's called capital risk. And this is something that for some reason, the financial press and even the press in general, the media doesn't really talk about. But here's an article from a year ago. 64% of Americans aren't prepared for retirement and 48% don't even care. Now, the sad thing is, if you look at this chart, this is how many people have saved zero. 45% of the people surveyed have zero savings. Now, 12.5 have 100 grand to at least $500,000, and almost 4% have 500,000 or more. Well, these are the people that are saving and have good jobs and are committed to it and have budgets and all that stuff. This is some kind of disastrous crisis that has to be resolved in the future. And I'm not even sure where that goes. But the idea is that capital risk is real. And we've got some clients at our firm that are young. And we're talking about them getting their 401ks early, saving, having budgets, paying attention to their rent, you know, not leasing super expensive cars, things like that, because not having enough money to save for future use, you can never recover from that potentially. So the idea is we want to show what you can do. So Fidelity last year did a study that was a 12-month period. From September 30th, 2019 to September 30th of 2020, they wanted to see how much money people saved in 401k plans. And they have access to all the data through the IRS and the Treasury. So they found out that the average savings was $600 per month, basically. So $7,270 per year was saved in 401k plans on average. Now let's see how that compares to different income stratas. So from a top 10% of income earners, and once again, this is going back to IRS data, that's a household that makes about $152,000 in household income, and they typically save about 9%. The top 5%, which is about $220,000 a year in income, they save about 12%. And the top 1% that we always hear about, it's a little bit more than $500,000. And once again, you think about this kind of tracks what we just saw with that thing about saving. And the top 1% saves about 38% of their income. So the challenge is that there's income available for them to save, but the other two groups, the top 5 and top 10%, are getting squeezed because of housing costs, cars, living expenses, medical expenses, education expenses for kids, a whole number of things. So taking a step back, being in the financial planning business and being in the financial retirement plan design business, there's really 4 things that determines someone's future income in their non-working years. And there was this big study done by 2 qualified QPAs, qualified plan administrators, and they identified 2 factors of the 4 ideas, the 4 aspects that really drive income in the future. And together, these 2 factors equaled what was going to happen in the future with a very high degree of certainty. The first one, that is only 26% of the outcome, is the asset allocation, the investments, and actuarial services, like what the plan administrator does on behalf of the participants. So that's 1/4 of the predictability of an outcome. What the bigger part was, with a high degree of certainty, 3 times as much, was how much someone saved. So if someone never saved enough, they could never accomplish their financial savings goal in the future. It just wasn't possible. You could have the best investments and the best allocation, and you just couldn't overcome the amount of money that wasn't available. So that's where this capital risk comes in, where we want to help people understand how to find or how to save the best way possible with what limited amount of money they have to devote to savings. Because if you're saving now, you're not spending it. And if you need to spend it on things, you got to figure out how to save better. So the idea is that, let me give everyone the first thing. Whenever I meet with someone, they always say, well, are we on track? And I say, here's a very simple formula to tell exactly where you stand from how much you have right now. So if you take your current income and multiply by 80%, Schwab did a huge study and said, on average, retirees in general live on about 80% of their income during their working years, because usually their house is paid off. Usually they're not saving anymore. So if 80% is a safe number, you can do 75 if you want to be more conservative, but 80% is probably good. So whatever your current income is, multiplied by 80%, that's how much your non-working income should be. Take your non-working income number and times it by 25. And a lot of people are like, well, 25, because that's actually years in retirement. The actual average is about 22. But if you're married and you're 65 years old, you have a 50% chance of living to age 89, one person in that household. So 25 is not an unrealistic number. And that number comes from the Social Security Administration, who has access to everyone's data. So that number is actually very accurate. So you take your non-working income number times 25, that's the pile of money, the asset number that you need. Because what you do then, in this case, this example, 200,000 times 80 would be 160,000 non-working income times 25 years equals $4 million. That's a huge number, by the way, because $4 million times 4%, which is how much, if you had an investment, you'd want to take out safely. You can take out more, but then you might run out of money before age 89. So we tell people statistically that's a number that's reasonable. So that would drive 160,000 in non-working income, and you could gross it up each year for inflation a little bit. So that's really the quick, as they say, back of the envelope or back of a napkin calculation for where you are. So the next thing I always hear about is, okay, well, what's that mean? Well, if you're in your 40s as a financial planner, you should be saving about a third of your income. Now that's not 9%, not 12%, like, the 10% to 5%, this is what the 1% are saving. But that funding gap is usually impossible to overcome. So I want to show you how you can overcome it. Once again, this is kind of the part of, what's out there. People don't know what they want until they know what they can have. So, there is a way to overcome it. Maybe not all the way up there, but a lot more than this. So backing up from where we are as retirement plan designers, top 10% usually save about 14,000 in their 401k plan. So a little bit more than 1,000 a month. The top 5% usually max fund their 401k plan. So that's, 19,500, 20,000 a year about, and they'll put a little bit more in a taxable account, a brokerage account. The top 1% max fund their 401k plan, and they typically have profit sharing plans that are either being highly matched or matched at a substantial level. So they're basically all retirement plan savings programs. But what the top 1% are doing is they're adding cash balance plans, which are company plans, and executive bonus plans, which are not necessarily company plans. They can be company plans, but they can be independent. So that's kind of where the difference of the savings between 9 and 12 and 38 comes from. So here's what we tell our clients to do when we're sitting down with a business and we're doing an enrollment meeting with their employees. In the old days, we'd go to the location and we'd have a PowerPoint in the back, and everyone was sitting with paper in front of them and a folder. Now we do Zoom meetings, and I'm not sure it's as effective. But what we tell the savers is the smart thing to do with limited money is save up to your 401k match. And a lot of times the 401k match, we have a spreadsheet we use where we'll show someone, this is QACA matches, qualified automatic contribution arrangement. And what that means is that's the standard IRS rule that lets a business owner provide a plan match that only is available to people that save. So it's a smart way for businesses to roll out a 401k plan where they're going to give money to people that are going to save. They're not going to give money to people that don't save. But the crazy thing is, look at these numbers. So if you put in, a maximum, if you're $200,000 to $100,000 of income, you're saving, 19 to 10% depending on your income, but you're only getting up to $7,000 or up to $3,500 in a match. So you're saving a lot and you're getting a little bit of a match. And if you're saving in these lower levels, you're saving, once again, this is 40% of your income almost to save that, and you're only getting $1,700. So your employer's plan is helping, but not really. It's free money. So we say save up to that number if you have a match. If you have a Roth 401k option in your 401k plan, save in that. Tax rates are as low as they've ever been in 100 years of the IRS being in existence. So the idea that rates are going to go up, tax rates are going to go up in the future, they're going to go up. It's not a matter of when, it's not a matter of if, it's a matter of how soon and how horrible potentially. So save up to a 401k match into a Roth 401k plan, or a Roth IRA, or a backdoor Roth IRA, or an executive bonus plan, which once again, this is what the 1% do. The last option that shows what the 1%ers do is they save into cash balance plans. And if your business has one, that's awesome. If you own a business or you have access to the CFO, this is something to talk about to find out if they have one, if they want to offer it. It's an idea because as a business owner, they're great for the business owners because they create a business expense where they can save on behalf of key employees and the owners and the shareholders, not necessarily a line employee program. So a lot of business owners, a lot of doctors, professional firms, CPA firms have cash balance plans. So these are like the three primary areas where people save. And the last thing where people save is just in taxable money, because this drives annual dividends, capital gains, just taxable income that you're not really using. So it's eroding your savings over time. So let me tell you the idea of what an executive bonus plan looks like and where the idea came from. And once again, this comes from our experience in the business, dealing with business owners and dealing with people that make $100,000+ a year in income. So executive bonus plans have been around since the 1960s. And what they're designed to do is overfund contributions and minimize plan expenses to create a pile of money that can be used as collateral to receive matches, and that's the security. And the wealthy families have been doing this for mostly to avoid estate taxation and income taxation. And this topic, every month when we have our Tampa Bay Estate Planning Council meetings, this is what people talk about. There's 1,000 ways to do it, but the idea is that you want to use as little of your own money, borrow money from banks, collateralize the cash you put into it, and then max up your savings to have more access to cash in the future. Now, Thoughtful Advisors partners with a company called NIW out of Dallas, Texas. They're our executive bonus plan provider. We ethically provide, as fiduciaries, affordable executive bonus plans to Main Street savers. Now, NIW is not some new company. They've been around since 2000, so they were formed after the tech crisis. They went through the credit crisis without issues, and they've done $5 billion in funding. So the idea is that this is not some new company that we hope works out. This is a company that has been doing this for a long time. The plan that they have is called Kaizen, and I'm kind of person that I would joke with my clients that there's an expression that says, never trust a skinny chef, which means if the chef's skinny, he must have bad food that he doesn't eat himself. So I tell people that every client that we have that has a service that we've told them to buy, someone in the LoDuca family owns, because I want to experience what my clients can experience before they experience it. So I tell people that if they have an investment account with us, or an insurance policy with us, or a 401k plan with us, or whatever is out there that we've sold, someone in my family owns it, whether it's my mom, myself, my wife, my kids, my brothers and sisters. LoDuca's own it, because we want to see how they're doing. We want to feel what they're feeling. So when a client says, well, what do you think? I say, yeah, my wife had the same question. Or, you know what, I thought the same thing when I saw that. So the idea is that, what exactly is Kaizen? What does this mean? So let me show you. I think this is about 2 minutes, so it's not super long.
Adding money to your retirement savings is the most important step to ensuring your ability to maintain your lifestyle. No matter how great you think your retirement plan is, you most likely are not saving enough to provide you and your family the supplemental income needed to maintain your current lifestyle. This is why so many fear outliving their retirement income. Kaizen is different because it adds 3 times more money to what you are currently saving, providing you the potential for 60 to 100% more supplemental income. Kaizen is designed to maximize your potential for growth while providing protection for you and your family by utilizing a uniquely designed cash accumulation life insurance policy. Your contributions are combined with leverage, adding as much as 3 times more money without the typical risks associated with borrowing. Your contributions are matched by the lender in the first 5 years. Then, the lender uses that as the security for the additional funds for the next 5 years. The plan design minimizes costs while maximizing your potential for growth. A small portion of the premium is used to cover policy expenses. The expenses provide death benefit protection for your family, or can be accessed to provide living benefits in the event of a chronic or terminal illness once the loan has been repaid. The surplus portion of the premium is used to provide you an opportunity to earn interest that is credited to the policy, based in part on changes in a major market index like the S&P 500 or MSCI. In addition to the potential for growth, the product provides an added layer of protection. In any year the index is negative, your policy would record 0%. Using a feature called the floor, Kaizen has minimized your potential risks and maximized your potential for growth. In addition, annual servicing, monitoring, and stress testing is provided as part of the plan until the loan has been repaid, in approximately the 15th year from policy cash values. This provides you the comfort of knowing you can access your policy benefits or take distributions when you are ready to retire. Adding more money in your plan makes it a lot easier to hit retirement goals. So when it comes to your retirement, Kaizen provides you the potential for 60 to 100% more. Kaizen. More money, more protection, more confidence.
So that's the executive bonus plan provider we use. So this goes to the, now that I know what's out there, why bother changing? Because the first thing is that if you have a thoughtful income tax-free plan from Kaizen, you can overcome the savings gap without blowing up your budget. Because once again, you're going to be saving. This is a matter of saving either a little bit more into this plan or saving some in your 401k plan and more in this plan. The idea is that you want to overcome the capital risk of not saving enough. Next one is the tax avoidance. And this is, I think, a bigger deal. The CBO, Congressional Budget Office, estimates that income tax is going to double by 2033. I tell people, I hope it takes that long for them to double, because I think they're going to, there's a lot of political intrigue in right now, and tax rates could be rescinded potentially soon. And who knows what's going to happen in the future. But the idea that they double during your retirement is a potential disaster from an income perspective. So the nice thing is that using this strategy, you protect against future tax rates because the income payable is tax-free and is not reported on your Form 1040. The idea is that you're going to eliminate tax risk by having tax-free income. So it's like a super Roth 401k or a super Roth IRA. So that's something. And the last thing is really the losses. Tax-free income, if you get positive growth in the index in that year, you get a credit to your balance. If there's a negative loss that year, you don't lose anything, you just get zero. So the idea is that once a gain is locked in, that value goes up. So if you have 100 grand, it goes up 10%. You have 110. If it goes down next year 20, you still have 110. So market risk. So this idea, cash flow 101, is the idea of using money to buy an appreciating asset. So the easiest example is mortgages. If you put down, in the old days, you had to put down 10, 20% of a mortgage, and you would buy a house. The idea is you could buy more of a house instead of paying cash for the whole thing. So if you have potential growth that's protected from market losses, you can overcome the funding gap by having leverage by borrowing against your savings. So the way it works is you have 5 annual payments. The cash contribution is the only collateral. 3 times matches on your cash contribution. Low borrowing rates, LIBOR plus 175. No personal guarantees, credit checks, loan documents, financial underwriting. No interest payments, no prepayment penalties. So the idea is that you get cash protection for your family and no liability other than having to make the contributions for 5 payments. So here's kind of where everyone's like, this is where I had to convince my wife about it, because she said, well, that sounds great, but what's actually happened? So this is an actual client statement. This is the rates of return per year. So the first year, client got 13 with a loan rate of 2.75. So the next year, 7.5, 275. So the whole idea is that they've averaged 8.18 since they started in 13. This has been the loan cost. So that's their earnings, that's their expense. The net on the cash that's been in the policy is 4.79. Now I know Patty's a banker, and I was a banker back in the old days. You used to be able to get 5% on a 5-year CD, but that was 1,000 years ago, unfortunately now. So this is almost a CD-like return, even though you're borrowing to leverage up the amount of money you're saving. So this is the 5 years of the payment made by the client. So the idea is that the policy design works. And the reason why we use this provider is it's the low financing, and the high exposure to growth that makes this work. Because if you had higher expense in either the bank loans or lower growth, these numbers get a little squirrely and the plan doesn't work very well. So let me show you actually something we do from a design perspective. And this is actually the design platform we use. And our firm's big on financial technology. The whole idea is that we want people to be able to get as much as they need for as simple as it's possible. So let me give you an example. So let's say, we'll use me. Let's say you're 55 and you're in excellent health and you want to put in $25,000 for 5 years. What would that show as an option? So this shows my 5 payments, the 5 matches from the lender, and then the matches from year 6, 7, 8 through 10 that the lender does on my behalf. So let me show. This shows a 9.9 internal rate of return. And that's the amount of money you put in to the amount of return you get on your money. This would show an initial death benefit. So if I pay one payment and die in a car accident, my family would get $700,000. I would get tax-free income of almost 34,400 a year from age 79 to 90. And when I die after my income, my family would still get $729 in death benefits tax-free. Now, the interesting thing is, this is kind of where you want to compare with what's out there. And this goes to the Sir John Templeton thing. This would be if you saved $25,000 a year for 5 years into a 401k plan. This would be what you'd have from the idea of a taxable brokerage account. This would be if you try to do the policy design on your own. And this is what we offer as the matching contribution. So this is why you can get so much more. And these are the comparisons. So if I was doing the same exact strategy in my 401k plan, I'd have $22,000, almost $23,000 a year of income versus $35,000 of tax-free income. It shows that you have death benefits associated with these where you don't in your 401k plan, and the rates of returns are significantly higher. So it's an idea of, if you're trying to save more and you're trying to save smarter, this checks the boxes of getting more savings, tax-free income, so you avoid the tax cost. So the idea is that there's a way to potentially do it better that's out there. So what we want to explain is, if you'd like to learn more, household income, the requirements are, and this is why it's not too good to be true, is that the household income has to be at least $100,000 to even be eligible for this program. I always joke with people, I'm not a sales guy. When I go into a department store, if I want to buy something, someone comes up to me and says, hey, can I help you? I'm like, no, I'll get you when I need you. I tell people I operate the same way. If you want to learn on your own, at your convenience, without anyone bothering you, you can email us your name, your age, and your gender, and we'll send you a link to that site I just showed you, where you can design your own plan. You can put in your age, your income, what health you think you are, and you can run your own numbers, because we have a lot of business owners that are like, hey, just send me the link. Let me look at it. I'll talk to my CPA and I'll get back to you. And I'm like, okay, here you go. So that's all we need. The idea is that you can do, we have a huge FAQ section where you can change all the inputs, and it's all confidential and it's secure. It's in its own portal. So the idea that, you can, if you decide to do something, everything's automated. You can sign up for it on your own. We can help if you want, but we want this to be something where we're giving you information and you decide to do something or not on your own. I'm not going to bother anyone. I'm not going to say, hey, you never sent me an email, or you never did anything. It's out there now. The idea is that we want to show people how simple it is. Really, you want to determine how much you want to contribute. You want to complete the online paperwork. It's all automated. And then you want to request simplified underwriting. And in this case, there's no blood work. There's no one bothers you. No one comes to your house. It's just a questionnaire. So you can get approved that way. And the last thing I just want to say, the chamber, especially as a former treasurer, if at all possible, try to support your local businesses. I tell people, we have a little hardware store on Beta Bay Hardware. I go there first before I go to Home Depot or Lowe's, because I want to support that business. I use Laura Webb does our insurance for the house, the cars. We want to support local businesses because they're the ones that drive the economy locally. I coach Little League Baseball. We have a banner in the outfield, and all the banners out there are from local businesses. I don't see a Google one out there, a Facebook one, a Home Depot one. You know, they're all local businesses. So support your local businesses. You know, our plans are designed and thoughtfully managed in South Tampa. So we're trying to, once again, I got to pay for some of these South Tampa Little League baseball banners. And once again, if there's any questions, as a CFP, certified financial planner, everything, we have like a doctor-client, doctor-patient privilege, lawyer-client privilege, where whatever you tell me as a CFP is confidential only between me and you, no one else. So if you have any questions, you can shoot me an email, you give me a phone call. But the idea is that we're out there. There's a way to do this better. This program can be available individually or as a business provided voluntary benefit that doesn't cost the business owner anything. So if you have a business and the business is looking to add voluntary benefits, it's a super AFLAC. AFLAC is a voluntary benefit. This is another way to add a benefit that doesn't cost the business owner anything. So that's it. So any questions? Well, see, there you go. I talk fast. It's 10:15. So I've given everyone back their 15 minutes before the 10:30 deadline. So if there's no questions, have a great afternoon. Go Buccaneers, and shoot me an email or give me a call if there's anything after the fact, or if you want to get one of those secure portal links where you can run your own scenarios.